Whether you're thinking of buying property, concerned about your residence, watching investment trends, or just curious about what's ahead in the Golden State, this video is for you. Before we begin, if you haven't already, please hit the subscribe button and turn on notifications. Let's get into it. Let's start with the current landscape in the state of California. Prices. In many metro areas, home prices have reached extremely high levels. Although the statewide median may vary, we're seeing median single-family homes selling for near or over $900,000 in some markets. Supply and demand imbalance. The basic dynamic behind the high prices is that demand has been strong for jobs, lifestyle migration, while supply, new home builds, land zoning, affordability has been constrained. Regional variation. The state is huge and diverse. Coastal tech hubs, inland regions, fire risk zones, rural and urban. So the dynamics differ significantly across regions. External pressures. In recent years, natural disasters such as wildfires have hit parts of California hard. For example, the major fires in early 2025 in Los Angeles area. Policy environment. The state governed by Gavin Newsom is taking steps, we'll cover in detail, to boost housing supply and deal with affordability. So to summarize, high prices, supply challenge, diverse regional risks, and active policy unknowns. Transition. With that scene set, let's dig into the major risk factors that could trigger a crash or correction. One of the classic crash triggers in real estate is when supply outpaces demand. When many homes flood the market, competition increases, and prices drop. Let's apply that to California. What's happening? Listings in some areas have been increasing. More homes for sale means more potential supply pressure. But statewide, inventory is still relatively constrained compared with historic norms. That means that while supply is loosening, it's not yet at burst levels in many places. Why supply matters. If sellers outnumber buyers significantly, then homes stay on market longer, price discounts grow. Builders and developers may respond to high prices by increasing construction, but in California they face high land costs, zoning restrictions, environmental reviews, and labor permit bottlenecks. California specifics. The state has passed legislation, e.g. Senate Bill 79, to ease density and transit-oriented housing in an attempt to boost supply. Yet, raising supply takes time, months to years. And meanwhile, if supply loosening meets demand weakening, that's where correction risk rises. What to watch for? The rate of new build completions. If completions surge, supply pressure increases. Days on market/inventory multiples. How many months of supply are sitting unsold? Regional mismatches. Some markets may oversupply faster, inland suburbs, while coastal markets remain supply constrained. Transition. So supply is loosening but not necessarily exploding yet. Let's move to the other major side of the equation, demand. High prices are one thing, but when they push many buyers out of the market, demand weakens, and that can trigger downward pressure on prices. Let's explore this deeply. Key data and signs. Affordability ratios. In many California metros, the ratio of median home price to median household income is extremely high. For example, historically 8 to 10 times income or more, which means many buyers are stretched. Interest rates. With rising interest rates, monthly mortgage payments become larger, reducing what buyers can afford and shrinking demand at the margin. Regional risk factors. Natural disasters, wildfires, high insurance premiums, insurance companies pulling back. These things increase cost of ownership. For example, in fire-prone areas around Los Angeles, insurance market pullback has been causing pressures. Investor-renter market shifts. When more buyers become renters because they can't afford to buy, demand for ownership drops. Specific concerns. If demand drops while supply is loosening, we get a double hit. More homes available plus fewer buyers equals price correction. Moreover, when buyers expect prices to soften, they may delay purchase, expecting a deal, which further weakens demand. What to watch for? Home sales volume trend. Are fewer homes being sold? A drop in volume often precedes price drops. Time to sell discounting. Are homes taking longer to sell? Are sellers dropping asking prices more often? Mortgage delinquency, stress in markets. Are there early signs of financial stress among homeowners or investors? Transition. So we have supply risk, demand risk. Now let's zoom in on another set of risks that are more structural and less visible. Beyond supply and demand, there are underlying structural issues and systemic risks in California's housing markets that could exacerbate a downturn. Investor ownership and speculation. In certain California regions, a significant share of homes are owned by investors, not just owner-occupiers. If those investors decide to offload in weak market conditions, supply jumps. Investor behavior tends to be more opportunistic. They may flip, rent out, or pull out quickly when risk rises. Natural disaster insurance climate risk. Areas prone to wildfires, floods, or climate-related events, e.g. around Los Angeles, face higher insurance premiums or fewer insurers willing to underwrite. This reduces the pool of qualified buyers and raises cost of ownership. A concrete example. In upscale neighborhoods like Pacific Palisades, after major fires, insurer withdrawal reportedly led to median sale price drop, 16%. Regulatory and policy risk. State policies shift. For example, the overhaul of the California Environmental Quality Act, CEQA, is aimed to reduce delays for housing development, but critics say it may cause other unintended consequences. Land use, zoning, local opposition, NIMBY, still strong in many areas, meaning supply push may face delays. Financial economic spillovers. If the broader California economy weakens, job losses in tech, entertainment, tourism, housing demand weakens. If mortgage rates spike further, affordability shrinks. What to watch for? Insurance availability premiums. Are policies being canceled or priced out in particular zones? Local job market trends. Are key sectors in the region shrinking? Investor portfolio behavior. Are investor-owned homes rising in supply? Transition. So we've covered the three major risk categories. Now let's bring in the leadership outlook, what the governor is saying and doing. Now let's talk about the state-level leadership, Governor Gavin Newsom, his concerns, his policy moves, and how that factors into housing market risk. What the governor is explicitly worried about. Governor Newsom has repeatedly highlighted the imbalance, too much demand chasing too little supply. He recognizes that without boosting supply, the affordability crisis will deepen. He has flagged the risk of homelessness, constrained mobility, economic inequality as connected to the housing market. Key policy responses. CEQA reform. Newsom signed major overhaul of CEQA in mid-2025, aimed at reducing regulatory delays and allowing construction in already developed areas to proceed faster. Housing legislation. The passage of SB 79, SEP 2025, made it easier to build dense housing near transit. The governor is expected to sign it and has supported similar measures. Why this matters for crash risk. On one hand, the governor's push to boost supply is a mitigating factor against a deep crash, because more supply may relieve upward pressure and better regulation may reduce cost of new units. On the other hand, if policy changes take time, years, and meanwhile demand weakens or risk events hit wildfire, insurance, then the timing mismatch may cause shorter-term pain. Message to viewers, if you're buying or investing, keep an eye on how local policy implementation is progressing. Is your region gaining from these reforms, or is it lagging? Transition. With all this background in place, let's ask the big question: crash or correction? And what should you, as a viewer, possible buyer, investor, do? Putting everything together with supply, demand, structural risks, policy, what's the outlook for California's housing market? Arguments for a crash, rising inventory and early signs of demand softening in certain markets. Affordability is so stretched in many areas that only a strong impetus, job growth, migration, can sustain further price growth. If that impetus slows, prices may fall. Structural risks, insurance crisis, natural disasters have already impacted certain zones significantly, e.g., high-risk fire zones already showing price drops. Investor behavior could accelerate declines in certain submarkets, especially if local economy weakens. Arguments against a crash. Supply is still constrained in many coastal and tech region markets, meaning large price drops may be less likely in those zones. The state's policy push, CEQA reform, SB 79, may help prevent a deeper collapse by relieving some supply bottlenecks and stabilizing markets. The California economy still has strong pockets, tech, entertainment, global migration, which may cushion the slowdown. My conclusion, I believe the California housing market is more likely to face a moderate correction or flattening over the next 12 to 24 months, rather than a dramatic crash like 2008. But make no mistake, this is not a business-as-usual upward ride scenario. Important caveats: some regions will see bigger declines than others. Fire, flood, climate risk zones, high investor ownership areas, and markets with weaker job base may already be entering correction territory. Some markets, prime tech hubs, restricted supply coastal enclaves may hold up better. But even there, expect slower growth, longer times on market, more cautious buyers, possibly stagnant or slightly falling prices. Practical advice for buyers and investors: focus on local fundamentals, not just statewide headlines. Assess affordability, compare median price versus median income versus interest rates in the micro market. Beware of risk zones. Ask about insurance availability, pricing, natural disaster exposure, and investor saturation. If buying, have a buffer for slower price growth or even modest drop. Plan for at least 3 to 5 years hold if possible. If investing, be extra vigilant in high-risk zones. Diversification matters. Don't assume everything in California rises forever. Transition. Let's wrap up with some final points, calls to action, and what you as a viewer should do now. So there you have it, a detailed deep dive into the question, is the California housing market going to crash soon? Key takeaways. The risk of a meaningful price drop is real, especially in vulnerable regions. But a full-blown crash across the entire state appears unlikely given present supply constraints and ongoing policy efforts. The most likely scenario: moderation, flattening, regional variability, slower growth, longer sales cycles, and selective declines. If you found value in this video, please hit the like button. It helps a lot. Subscribe to my channel if you haven't already. Comment below. Which California region do you think is most at risk and why? Or do you see opportunity? And share this video with someone who's thinking about buying a home or investing in California real estate. The more informed we are, the better decisions we make. Thanks so much for watching. Take care, stay informed, and I'll see you in the next video.